Hello everyone, welcome to the channel. I'm John, and today we are covering one of the most shocking market developments of February 2026, because gold and silver have just experienced a violent crash, and it has left investors across the United States asking the same urgent questions. What just happened? Is this the beginning of something bigger? Did China trigger this meltdown? Is the US economy in danger? And most importantly, what are the real economic effects of a precious metals collapse? In today's video, we are going deeper than the headlines. We are not here for rumors. We are here for real market structure, real macro forces, and the true global debate. Here's exactly what we are going to break down. First, we will explain what caused the sudden crash in gold and silver, and why this was not just a normal pullback, but a major liquidity and positioning event. Second, we will answer the big geopolitical question: is China involved in this crash? And can China's economy actually go down because metals are falling? Third, we will examine the US side of the story. Can gold and silver crashes really damage the American economy? Or are these moves mostly Wall Street volatility rather than Main Street collapse? Fourth, we will expose the true macro forces that can actually bring down economies, including interest rates, housing stress, debt pressure, deflation risk, and global shocks. And finally, we will end with the most important conclusion: what this crash is really signaling, and what investors should watch next as markets reset in 2026. So make sure you stay until the end, because the final truth about this metals crash is not what most people think. If you find this analysis valuable, don't forget to hit the like button, subscribe to the channel, and turn on notifications, because I bring you weekly updates on gold, silver, Bitcoin, and global economic shifts that mainstream coverage often misses. All right, let's begin with what really caused the February 2026 gold and silver crash, and why the entire world is watching this moment closely. Now, let's address one of the most important questions in this entire debate. A lot of people are asking right now, did this silver crash actually hurt China? Or even more dramatically, could silver crashing be a sign that China's economy is going down? So let me explain this very clearly. Silver does not control China's economy. China is not a small commodity-dependent country. China is the world's second largest economy, nearly a $19 trillion system. That means silver price movements do not crash China by themselves. However, silver can still matter indirectly, because silver is not just a precious metal. Silver is also a major industrial input. It is used in electronics. It is used in manufacturing. It is used heavily in solar panel production. And China is the world's largest industrial producer of many of these technologies. So when silver falls sharply, markets are not saying China collapsed. Markets are reacting to what silver represents. Silver weakness can signal fears of weaker industrial demand, and industrial demand is tied directly to China's growth cycle. For example, if investors believe China's factories are slowing, if solar exports are weakening, if electronics demand is cooling, then silver becomes one of the first metals to drop violently, because silver sits right at the intersection between safe haven investing and real industrial consumption. But here's the key truth. China's economic challenges in 2026 are not being driven by silver. China's slowdown is mostly connected to much larger forces: the property sector adjustment, consumer spending weakness, export uncertainty, and government stimulus decisions. That's what the IMF and Reuters have been focusing on. So silver does not crash China. Silver reflects the anxiety around China's industrial momentum. In other words, silver is not the cause. Silver is more like a financial thermometer. It reacts when the market fears global growth is cooling. And because China is such a dominant player in industrial demand, every major move in silver becomes tied to the China growth story. So the bottom line is this: silver's crash is not China collapsing. Silver's crash is a warning sign that markets are nervous about industrial demand, and China sits at the center of that demand. Did the US economy go down because silver crashed? Now let's address another major question people are asking in America right now. Did the United States economy fall because silver crashed? Did silver collapsing mean the US is entering a recession? And the answer is very clear. No, the US economy does not crash because silver prices fall. Silver is not large enough to drive the American economy by itself. The United States is a $28 trillion economy. It is powered mainly by consumer spending, technology, services, employment, and Federal Reserve policy. So silver does not control America's economic direction. However, just like China, silver can still matter indirectly, because silver is not only a precious metal. Silver is also an industrial metal. It is used in electronics, medical equipment, solar panels, automotive systems, and defense technologies. And the US has major industries connected to these sectors. So when silver crashes sharply, Markets are not saying the US economy collapsed overnight. Markets are reacting to what silver represents. Silver often reflects investors' stress about global industrial demand, a manufacturing slowdown, and tightening financial conditions. So silver becomes a signal, not a cause. Now, could a silver crash hurt parts of the US economy? Yes, in limited ways. A silver collapse can impact mining companies, commodity traders, ETF investors, and certain industrial supply chains. It can trigger volatility in Wall Street positioning, especially when leveraged funds unwind quickly. But that is a financial market event, not a full US economic collapse. The real drivers of America's economy in 2026 remain much larger forces. Interest rates, inflation expectations, consumer confidence, government spending, and corporate earnings. So silver is not pulling the US economy down. Silver is reacting to the same macro pressures the US market is facing. In other words, silver didn't crash the American economy. Silver crashed because investors were repricing risk, unwinding leverage, and responding to Federal Reserve uncertainty. Silver is not the engine of the US economy. Silver is more like a market thermometer. It moves violently when investors fear global growth is cooling, or when financial conditions tighten. So the bottom line is this: the US economy is not collapsing because silver fell. Silver is simply one of the first assets to reflect market anxiety, liquidity stress, and macro uncertainty. Silver didn't crash America. Silver crashed because Wall Street is nervous about growth, rates, and liquidity, and silver reacts first. Can gold crash take down China's economy? Now let's address another major question people are asking right now. If gold is crashing, can that crash actually bring down China's economy? Could a gold collapse trigger an economic crisis inside China? And the answer is very clear. No. A gold price crash does not directly take down China's economy. China is not a small commodity-dependent country. China is the second largest economy on Earth, a nearly $19 trillion system. Its growth is driven by much larger forces: manufacturing, exports, consumer spending, property sector adjustment, and government stimulus policy. Gold is not the engine of China's economy, so gold does not crash China. However, just like silver, gold can still matter indirectly, because gold plays a special role inside China's financial psychology. Gold is seen as a store of value, a reserve asset, a wealth protection tool for households and investors. And that is why China has remained one of the major buyers of gold, even at record prices. Reuters reported that Chinese demand stayed strong despite prices surging to historic highs. So China was not dumping gold. China was still buying into the gold rush. But here is what markets need to understand. The gold crash in February 2026 was not caused by China collapsing. It was driven mainly by global financial positioning. After gold hit record highs, the trade became crowded. Speculators piled in, and then when interest rate expectations shifted, the rally snapped. Financial Times described this sell-off as a speculative unwind, not a China-driven economic shock. Reuters also reported that JP Morgan still forecasts gold reaching $6,300 an ounce by the end of 2026 because central bank demand remains powerful. And China is part of that long-term reserve diversification trend. So what does that mean? It means gold crashing is not China falling. Gold crashing is the market repricing risk. Now, could a gold crash hurt parts of China indirectly? Yes, in limited ways. A sharp drop can impact retail investors holding leveraged metals products, consumer sentiment in jewelry markets, and short-term financial volatility. In fact, China's largest bank, ICBC, warned investors in early February that precious metals have become extremely volatile, urging caution. That tells you something important. China sees turbulence, not collapse, because China's real economic challenges in 2026 are much bigger than gold. The big drivers are property sector restructuring, slower domestic demand, export uncertainty, and policy stimulus decisions. Gold is not causing those problems. Gold is reacting to the same macro stress. So the bottom line is this: gold cannot crash China's economy. Gold is not the trigger. Gold is more like a market thermometer. It moves sharply when investors are nervous about global uncertainty. And China remains one of the biggest long-term buyers, not a country being destroyed by a gold correction. Gold didn't crash China. Gold crashed because global markets unwound a crowded rally, while China remains a key long-term buyer, not the victim of economic collapse. Can a gold crash bring down the U.S. economy? Feb 2026 debate. Now, let's address a question a lot of Americans are asking right now. If gold is crashing, can that crash actually bring down the U.S. economy? Could a sharp drop in gold trigger a recession in America? And the answer is very clear: no. A gold price crash does not directly take down the U.S. economy. The United States is a nearly $28 trillion system. It is driven mainly by consumer spending, jobs, services, technology, corporate earnings, and Federal Reserve policy. Gold is not the engine of the U.S. economy, so gold does not crash America. However, gold can still matter indirectly, because gold is not just a commodity. Gold is also a major financial asset inside the U.S. market. It's a hedge. It's a liquidity trade. It's a positioning trade. And when gold moves violently, it can create shockwaves across Wall Street. Now, here's what happened in early February 2026. Gold fell sharply after hitting record highs. Financial Times described this as a rally losing momentum, with speculators pulling back after a macro shift, and gold dropping around 7.8% while silver fell even harder. Reuters also described how the precious metals meltdown spilled over into broader markets, triggering a wider sell-off and risk reduction across assets. So what does that tell us? It tells us something important. This was not the U.S. economy collapsing. This was the market deleveraging, a crowded trade unwinding, a liquidity event. Now, could a gold crash still hurt parts of the U.S. economy? Yes, but in limited and specific ways. A gold crash can hit gold miners, commodity funds, ETFs tied to gold, and trading desks that were positioned aggressively. And that can spill into broader risk sentiment temporarily. In fact, we have proof that U.S. investors were very heavily involved in gold through ETFs. The World Gold Council reported that U.S. gold demand surged in 2025 largely because ETF investment jumped, with U.S. gold-backed ETFs attracting massive inflows and holdings reaching record levels. So when gold corrects sharply, well, they can cause financial market stress. But that is not the same thing as crashing the American economy, because the U.S. economy doesn't rise and fall based on gold alone. America's biggest drivers in 2026 are still interest rates, inflation expectations, employment, credit conditions, and fiscal policy. And that connects to the key debate right now. Even after the sell-off, Reuters reported JP Morgan still projects gold could reach $6,300 an ounce by the end of 2026, pointing to strong investor demand and central bank buying as structural support. So in the mainstream institutional view, the gold crash is not the end. It's a violent correction inside a bigger macro story. Now here's the bottom line. Gold cannot crash the U.S. economy. Gold is not the trigger. Gold is more like a market thermometer. It moves violently when investors are nervous about policy, rates, and liquidity. So if you see gold crashing, the real question is not, is America collapsing because of gold? The real question is, what macro fear is the gold market reacting to right now? Because in February 2026, the evidence points to positioning unwinds and macro repricing, not an economic collapse caused by gold. Gold didn't crash America. Gold crashed because Wall Street unwound a crowded trade, and the U.S. economy is driven by rates, jobs, and policy, not by one metal. What can actually bring China's economy down in 2026? Now let's address the real question. If gold and silver are not powerful enough to crash China, then what actually can bring China's economy down? Because the truth is, China's economy does not fall because of one metal price. China's economy weakens only when major structural pillars begin to break. So let me walk you through the real analyst-level factors that matter in 2026. The first and biggest one is the property sector. China's real estate market has been one of the core engines of growth for decades. Housing has represented household wealth, local government revenue, construction jobs, and financial stability. So when the property sector slows, the impact spreads everywhere. The IMF has repeatedly pointed out that China's property adjustment remains one of the biggest downside risks to growth. And analysts agree. If the housing correction deepens further, China's economy faces serious pressure. Now, the second major factor is weak consumer demand and collapsing confidence. China is trying to shift toward a domestic consumption-driven economy, but households have been cautious. People spend less when home values fall, jobs feel uncertain, and wages slow down. Reuters polling shows China's growth is expected to slow further in 2026, increasing pressure on policymakers to respond. Because without strong consumer demand, growth becomes fragile. Now, the third major risk is deflation pressure. Deflation is one of the most dangerous economic traps. When prices fall, companies earn less, wages stagnate, debt becomes heavier, and consumers delay spending even more. The IMF notes that inflation remains very low, and demand is still soft. Deflation is not just an economic number. It is a confidence crisis. The fourth factor is unemployment stress, especially among younger workers. China's youth unemployment issue is one of the biggest underlying vulnerabilities. A weak labor market reduces consumption, destroys confidence, and creates long-term structural challenges. Even if GDP appears stable, Jobs determine social stability. Now, the fifth key threat is local government debt. Chinese local governments borrowed massively for infrastructure and development, but now property weakness means land sale revenue is collapsing. Debt burdens are rising, and fiscal space is shrinking. The IMF highlights local government financing risks as a major structural concern. Debt overhang limits stimulus power. Now, the sixth factor is export decline and global trade restrictions. China's export engine is facing pressure from weaker global demand, supply chain diversification, and US-China technology restrictions. Trade fragmentation is now a serious headwind. A slowdown becomes deeper when exports weaken, because China's manufacturing machine depends on global flows. The seventh factor is geopolitical shock. A major escalation around Taiwan, or deeper US-China conflict, would trigger one of the strongest economic shocks possible. Markets would respond with capital outflows, currency pressure, investment collapse, and potential sanctions risk. Geopolitics is one of the few events that could rapidly change China's trajectory. The eighth factor is financial system stress. China has large hidden leverage through shadow banking, developer loans, and wealth management products. If credit stress spreads, confidence can crack quickly. A systemic financial event is one of the most serious macro risks. And finally, the ninth major factor is policy mistake or weak stimulus response. China's economy is heavily shaped by government action. A slowdown becomes dangerous if stimulus is delayed, reforms are too slow, or confidence is not restored. Reuters notes pressure is rising on policymakers as growth moderates. The timing of policy response often determines whether weakness becomes crisis. So the bottom line is this: China will not collapse because gold crashes. China weakens if structural pillars fail. Property, consumer demand, deflation, debt, exports, geopolitics, financial confidence, and policy response. These are the true macro forces. Gold is not the cause. Gold is only the signal. China won't go down because metals crash. China slows down if property debt, deflation, consumer confidence, trade pressure, and geopolitical risk combine into a structural crisis. Effects of gold and silver crash on the U.S. economy, expert analysis. Now let's talk about something very important for Americans right now. Gold and silver have just crashed sharply, and a lot of people are asking the same question. What does this actually mean for the United States economy? Does a gold and silver crash bring America down? Does it signal recession? And the expert answer is very clear: no. A metals crash does not collapse the U.S. economy, but it does create powerful ripple effects inside financial markets. So let me explain this clearly, step by step. The first major effect is market volatility and investor shock. Gold and silver are considered safe haven assets. They are supposed to hold value during uncertainty. So when they suddenly fall hard, it shocks investor confidence. It creates anxiety that something may be breaking underneath the surface. Even if the real economy is not collapsing, financial fear can rise quickly. Now, the second major effect is concentrated losses for traders and investment funds. Gold and silver are heavily traded in America through futures markets, commodity ETFs, and leveraged hedge fund positions. So when prices crash, margin calls begin. Forced selling accelerates, and some funds take major losses fast. This is a Wall Street event, not an immediate Main Street collapse, but it creates stress in the financial system. The third effect is pressure on mining and resource industries. The United States has companies tied directly to gold and silver production. When metal prices fall sharply, profitability drops, new mining investment slows, and jobs in those sectors can face pressure. It's not the biggest part of GDP, but it matters regionally. Now, the fourth and most important macro effect is what metals crashes signal about financial conditions. Gold and silver often fall when interest rate expectations rise, the dollar strengthens, or liquidity tightens. So a metals crash can function like a warning indicator. It tells you markets may be repricing money and risk. That matters far more than the metal itself, because tighter financial conditions impact borrowing, housing, business expansion, and corporate credit. The fifth effect is inflation expectation shifts. Gold is closely tied to inflation psychology. When gold collapses, markets may interpret that inflation fears are cooling or that rate cuts may not arrive soon. This affects bond yields, Federal Reserve expectations, and macro positioning across markets. Now, here's an important truth. The sixth effect is that consumer impact is actually limited. Most Americans do not own large amounts of physical gold or silver. Gold is not like gasoline. Silver is not like housing. So the direct impact on everyday consumer spending is small. This is not a household-driven recession trigger. The seventh effect is safe haven rotation into the US dollar and treasury bonds. When metals fall, money often rotates toward cash and US fixed income. That can strengthen the dollar. A stronger dollar can hurt exporters, but it can also reduce import inflation, so the impact is mixed. And finally, the eighth and biggest conclusion is this. Gold and silver crashes are primarily financial market events, not economic collapses. The US economy is driven by employment, consumer spending, technology, corporate earnings, and Federal Reserve policy. Metals do not power America. Metals reflect investor emotion. They are indicators, not engines. So the bottom line is very clear. Gold and silver crashing does not bring down the United States economy. But it can create market volatility, trader losses, liquidity stress signals, and shifts in Federal Reserve expectations. It is a financial ripple, not an economic earthquake. Gold and silver didn't crash America. They crashed because markets unwound leverage, and the U.S. economy is driven by jobs, rates, and spending, not by one metals trade. What factors can actually bring the U.S. economy down in 2026? Now let's ask the real question. If gold and silver do not crash America, then what actually can bring the U.S. economy down? Because the United States does not fall because of one metal, the U.S. economy weakens only when major structural forces break. So let me explain the real factors that can truly push America into an economic downturn. The first and most powerful one is Federal Reserve tightening and high interest rates. The U.S. economy is extremely sensitive to borrowing costs. When rates stay high, mortgages become expensive, business loans slow down, consumer credit tightens, and economic activity begins to cool. Rate policy is one of the biggest drivers of recession risk. The second major factor is inflation squeezing households. Even if wages rise, persistent inflation reduces purchasing power. When Americans feel poorer, they spend less. And consumer spending is the largest engine of the U.S. economy. So inflation, especially in food, housing, and energy, can weaken growth significantly. Now, the third factor is labor market deterioration. The U.S. economy is held up by jobs. If unemployment starts rising, confidence collapses fast. Spending drops, corporate profits weaken, and recession dynamics accelerate. Jobs are the foundation of American stability. The fourth factor is a major credit or banking stress event. If banks tighten lending sharply or credit shock hits markets, business investment slows, housing contracts, and financial stress spreads. The U.S. economy runs on credit, so credit events can downshift growth rapidly. The fifth factor is a housing downturn. Housing is not just real estate. It connects to construction, consumer wealth, mortgage markets, and banking exposure. When housing slows, the ripple effect is large. Housing crashes have historically been major recession triggers. The sixth factor is geopolitical and energy shock. A war, supply disruption, or oil price spike can instantly hit inflation, reduce consumer spending, and trigger risk-off market behavior. Energy is still a key vulnerability for global growth. The seventh factor is corporate earnings collapse and equity market stress. Their profits decline sharply, companies cut jobs, capex falls, and investment weakens. A stock market downturn alone does not always cause recession, but combined with high rates, it can amplify economic slowdown. The eighth factor is government fiscal instability or debt ceiling chaos. The U.S. relies on stable treasury markets. If political dysfunction triggers uncertainty, bond yields rise, confidence weakens, and financial volatility increases. Policy stability matters for economic momentum. And finally, the ninth major factor is a global slowdown spilling into the U.S. America is not isolated. Weakness in China, Europe, or global trade reduces demand for U.S. exports, hits multinational earnings, and pressures global financial markets. Global slowdown becomes domestic slowdown. So the bottom line is this. The U.S. economy does not go down because gold crashes. The U.S. economy goes down if these pillars break. High interest rates, sticky inflation, job losses, credit tightening, housing contraction, geopolitical shocks, corporate profit decline, policy instability, or global recession spillover. Those are the true macro forces. Metals are indicators, not the cause. America doesn't collapse because gold and silver falls. America slows down when rates stay high, jobs weaken, credit tightens, housing cracks, and macro shocks hit consumer spending. So now, after everything we have discussed today, let's bring this all together with a clear final conclusion. Gold and silver did not crash because China collapsed. And gold and silver did not crash because the U.S. economy is falling apart. What we witnessed in February 2026 was not the end of the global system. It was a violent market reset, a correction driven by leverage, crowded positioning, margin calls, and macro repricing. Silver and gold are not powerful enough to destroy China's economy. China is a nearly $19 trillion system. Its true risks come from structural forces: property sector stress, weak consumer demand, deflation pressures, local government debt, export challenges, and geopolitical uncertainty. Metals do not cause China's slowdown. Metals reflect global anxiety about China's industrial momentum. In the same way, gold and silver cannot bring down the United States economy. America is a nearly $28 trillion economy driven by employment, consumer spending, interest rates, credit conditions, housing markets, and Federal Reserve policy. A metals crash creates financial ripple effects, volatility, trader losses, and shifting inflation expectations, but it does not collapse Main Street. So the final truth is this: gold and silver are not the engine of the world economy. They are the thermometer. They move first when markets sense tightening liquidity, changing policy expectations, or rising global uncertainty. And the real factors that can bring economies down are much larger than metals: high interest rates, credit tightening, housing downturns, debt crises, geopolitical shocks, deflation spirals, and policy mistakes. So as investors and observers, the key lesson is simple: do not mistake a metals crash for an economic apocalypse. Understand what the metals market is signaling, watch the macro forces underneath, and stay focused on real fundamentals, not fear-driven headlines. Because in markets, corrections are painful, but they are also part of the cycle. And those who stay informed are always positioned better than those who panic. And with that, everyone, thank you for watching today's deep analysis. If you found this breakdown valuable, make sure to hit the like button, subscribe to the channel, and turn on the notification bell, because I post weekly updates on gold, silver, Bitcoin, and global macro shifts that the mainstream media often misses. And let me know in the comments, do you think this crash was just a reset or the beginning of something much bigger? This is John AD, and I'll see you in the next video. Until then, stay sharp, stay informed, and as always, thank you for watching.